In 2022, something happened that almost nobody on the internet talked about. Not a stock crash, not a crypto collapse, not a bank failure. Something quieter and far more dangerous. The bond market. The largest financial market on the planet. Bigger than the stock market, bigger than real estate, bigger than anything most people have ever heard of, lost more value in a single year than at any point in modern history. We're talking about $31 trillion in losses, globally, in 1 year, and most people had no idea it was happening, because nobody explained it to them, because the bond market is one of those things that finance people wave their hands at and say, it's complicated. And then they change the subject. It's not complicated. It's actually elegant. And once you understand it, you start to see it everywhere. In your mortgage rate, in your government's decisions, in why the Fed matters, in why billionaires lose sleep over things the rest of us never even Google. So let's fix that right now. Start simple. Forget everything you think you know about finance for a moment. Imagine you need money. You're a government. Let's say you're the U.S. government. You've got bills to pay. Defense, healthcare, roads, salaries. But you've spent more than you've collected in taxes again. So you need to borrow. Now, you could go to a bank, but you're a government. You don't do that. Instead, you go directly to the public, to investors, to pension funds, to foreign countries, to basically anyone with spare cash. And you say, lend me money. I'll give it back in 10 years, and every year I'll pay you interest. That agreement, that IOU, is a bond. That's it. A bond is a loan. The borrower is usually a government or a corporation. The lender is whoever buys it. And in exchange for the loan, the borrower promises two things: regular interest payments, called the coupon, and the full amount back at the end, called the principal. Simple. Except here's where it starts getting interesting and a little strange. When the U.S. government issues a bond, let's say a 10-year Treasury bond, they set an interest rate on it. Let's call it 4%. If you buy a bond worth $1,000, the government pays you $40 a year for 10 years, then hands back your $1,000 at the end. That sounds reasonable, boring even, like a savings account with extra steps. But here's the thing most people don't realize. Once a bond is issued, it doesn't just sit in a drawer. It gets traded on a massive global market every single day. Investors buy and sell these things like stocks, except the market is twice the size of the global equity market. And this is where the magic, or the madness, begins. When you trade a bond after it's been issued, its price moves. It goes up, it goes down. And here is the single most important, most counterintuitive fact about bonds that you will ever learn. When bond prices go up, yields go down. When bond prices go down, yields go up. They move in opposite directions, always, without exception. Let's prove it with numbers, because this is worth understanding properly. You bought that $1,000 bond paying 4%, so $40 a year. Now imagine interest rates in the broader economy rise. New bonds being issued are now paying 5%. Suddenly, your 4% bond looks less attractive. Why would anyone pay $1,000 for your bond when they can get a new one that pays more? They wouldn't. So the price of your bond falls. Let's say it drops to $800. But the bond still pays $40 a year. That's fixed. It doesn't change. So now, someone buying your bond at $800 is effectively getting a yield of 5%, because 40 divided by 800 is 5%. The price fell, the yield rose, opposite directions. This is the heartbeat of the entire bond market, and once you feel it, everything else makes sense. Now, let's talk about what this actually means in the real world. Governments issue bonds constantly, trillions of dollars worth every year. The U.S. alone has over $27 trillion in outstanding Treasury debt, and a massive portion of it is held by institutions, pension funds, insurance companies, foreign central banks, sovereign wealth funds that bought these bonds expecting stability. They didn't get stability in 2022.
When the Federal Reserve started raising interest rates aggressively to fight inflation, bond prices collapsed. Because remember, higher rates mean lower bond prices. That's the rule. The average long-term U.S. Treasury bond lost about 30% of its value in 2022. 30%. That's the kind of loss people associate with stocks in a crash, not bonds. Bonds are supposed to be the safe thing, the boring thing, the thing your financial advisor puts in your portfolio so you sleep at night. But here's the absurdity. Nothing about the underlying loans changed. The U.S. government still owed the same money. It was still going to pay it back. The math of the IOU was identical. What changed was the price the market was willing to pay for that IOU today. And when you have $31 trillion moving like that, the ripples go everywhere. Banks that had loaded up on long-term government bonds suddenly found their balance sheets underwater, which, by the way, is exactly what happened to Silicon Valley Bank in 2023. They hadn't made risky loans. They had bought U.S. Treasury bonds, the safest asset in the world. And it still nearly broke them. There's a version of the bond market story that gets told in every introductory finance class. It goes like this. Bonds are safe, stocks are risky. As you get older, shift your money from stocks into bonds. Sleep soundly. It's not wrong exactly, it's just incomplete in a way that matters. What the textbook version leaves out is that bonds carry their own specific kind of risk. Not default risk, the risk that the borrower won't pay you back. That's real but rare for government bonds. The hidden risk is something called duration risk. Duration is a measure of how sensitive a bond's price is to changes in interest rates. The longer the bond's maturity, the longer you've agreed to wait for your money back, the more its price swings when rates move. A 30-year government bond has enormous duration. A 2-year bond has very little. In a low-rate environment, like the decade following the 2008 financial crisis, everyone piled into long-duration bonds because they paid more interest than short-term bonds, and interest rates seemed like they'd never rise again. Central banks had made them so low for so long that people stopped imagining they'd move. Then they moved, fast. And the people who had been congratulating themselves on holding the safe assets watched years of gains evaporate in months. The irony, of course, is that this wasn't a surprise. Everyone who understood duration knew it was possible. The risk was in the open. It was in the math. People just chose not to look. Here's where we zoom out. The bond market doesn't just affect investors and pension funds. It affects you directly. Your mortgage rate is tied to Treasury yields. When 10-year Treasury yields rise, mortgage rates rise. The cost of borrowing for a new home goes up, which is why rates that were 3% in 2021 were nearly 8% by late 2023. Treasury yields moved, mortgage rates followed. Your government's budget is shaped by bond yields. When the U.S. pays higher interest on its debt, that's money that can't go to schools or roads or whatever you think the government should be spending on. In 2024, the U.S. paid more in interest on its debt than it spent on defense. That happened. That's not hyperbole. That's an arithmetic fact. And here's the thing about debt at scale. When you owe $27 trillion, even 1% rise in interest rates costs you $270 billion more per year. Just in interest. Just to stand still. Not to borrow more. Not to build anything. Just to service what already exists. Every major economy on Earth is navigating some version of this right now. Japan, the UK, the Eurozone, China. They all have bond markets, they all have governments that borrow, and they're all watching the same impossible balance. Raise rates to fight inflation, but don't raise them so far that the cost of your own debt becomes unmanageable. It's like trying to brake a car that also has a bomb wired to the brake pedal. So what does all of this leave us with? The bond market is not a mysterious thing that lives in the background. It's the financial plumbing of the entire world. It sets the price of borrowing. It shapes government budgets. It determines whether your savings grow or shrink. It helped create the 2008 financial crisis. It helped create the inflation crisis of 2022. And it will be at the center of whatever comes next. And here is the question I'll leave you with, the one that nobody in the financial press is asking clearly enough. If governments can only sustain their debt loads when interest rates are low, and if central banks can keep rates low when inflation is under control, and if inflation comes back every time you flood the economy with cheap money, then what exactly is the plan? Not the stated plan, not the press release, the actual mathematical plan. Because right now, the bond market is pricing in a future where rates stay elevated for years, and elevated rates on debt of this size lead somewhere. Nobody knows exactly where, but the bond market is already telling us it's paying attention. Whether the rest of us are is a different question.